Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. This is a live show that we do every Tuesday to help you learn the ins and outs of passive investing. If you haven't done so already, in order to get plugged into future episodes, get access to my calendar, as well as see our open deals here at passiveinvesting.com, be sure to go to passiveinvestingwithwhitney.com. That's the only place that you can get access to my free ebook, access to my calendar, so we can discuss how we can help you meet your goals here via passive investing, and to see our open deals. Now, before we get started, I am super excited to have here today one of the tax gurus in real estate, Brandon Hall of Hall CPA. Brandon, welcome to the show.
Thank you so much for having me. I'm really excited to be here today.
Excellent. Guys, so I know you guys are here live. We've done many tax shows in the past. I know a lot of people are going to have individualized questions. Now, feel free to go ahead and drop them over, any of your questions over into the Q&A box. But for the first half of the show, we're going to just focus on just some broad strokes questions around real estate. And if you're here live, stay until after the show and we'll get into a rapid fire round with Brandon. Now, before we do that, Brandon, tell us a little bit about yourself, how you got into this wonderful world of accounting, and more importantly, around real estate.
Yeah, so I got started in, I think it's 2015 technically, but I launched my firm in 2016, or I went full time in my firm in 2016. So I took a job at PricewaterhouseCoopers, Big Four accounting firm, and then I switched over to Ernst & Young about a year and a half into my career, and I stayed at Ernst & Young for about another year and a half. So I did Big Four accounting for about 3 years. I was on the consulting side, wasn't on the tax side. But throughout that entire process, I was thinking, how do I not have to work a corporate job, right? Much like everybody kind of does before they get into real estate. So I found real estate as a way to potentially create cash flow that would allow me to replace my income and, sit on the beach and drink cocktails. So that was kind of my dream at that point. So I bought my first 3-unit back in 2015. I found bigger pockets, and I was asking a bunch of questions about buying real estate. But through that process, I realized that there were a lot of people asking tax questions. So I had just bought my 3-unit property. I was also answering tax questions on the forum just because I thought it was fun. And around the same time, I was starting to do the math on this cash flow that I was getting from this 3-unit property. Now, this 3-unit property I still have today. It's the best asset that I've ever purchased. I put like $30,000 into it in total between the down payment and the rehab. And it cash flows like $1,000 a month. So it's amazing. But I started doing the math and I realized, it was going to take me 15 years or so. Cause I wasn't really a big fan of like 0% down type of financing. I wanted to do 20% down. So when I started doing the math, I was like, oh man, this can take me a long time to actually replace my income. So I started pivoting and I started looking for another way out. And that's where answering the tax questions on the Bigger Pockets forum kind of came into play. So was answering those questions, people started reaching out and asking, hey, are you taking on tax clients? And I'd always kind of wanted to run my own show, but I didn't really know what that looked like. So finally, I just started saying yes to people and just started figuring it out. But that allowed me to launch my firm officially in 2016, go full time into it, quit my Ernst & Young job. And then today we have, 43 or so employees in the United States. We've got another 20 offshore employees between the Philippines and India. We made the Inc. 5000. We're the fastest growing accounting firm in the United States. We only do real estate. So 100% of our clients are in real estate. We work in every single state. We work with some really big clients. Like totally, if you told me that this was going to be my story 6 years ago, I would have laughed at you. But one of our biggest clients is a multi-billion-dollar private equity fund, and we're their outsourced accountants. And it's just crazy. It's been a really, really fun ride. But I've been lucky to come at it from a business sense where I think most accountants don't. I approach my firm totally differently. So I view it as building a platform so that other CPAs that are way smarter than me can come on and be highly successful. And so I have hired some people that are just like, I thought I knew what I was talking about. And then they start talking. I'm like, I have no idea what I'm talking about, but let's get you on a webinar. Right. So yeah, that's been kind of in my journey. It's been a lot of fun. I have 25 units today. And then I've got the CPA firm that's continuously scaling. So yeah.
Oh, that's amazing. Amazing story. And so many people's journeys, I bet even a lot of people that are listening here have started with bigger pockets and just interacting in those forums. And, you go there to get value, but also to provide value, right?
Oh yeah. And when I was at my corporate job, I like, I had a lot, looking back, there was a lot of luck in terms of the timing, because in most corporate jobs, you don't really get feedback, right? You get the December feedback where they're like, hey, remember when you came into the office in February and you were late? Well, you just got dinged 3 points on that. It's like, what? Nobody told me that back in February. You're waiting until December. That was my experience. And so when you go and you start answering questions on this online forum and everybody starts going, oh my gosh, thank you so much, you're so smart. It becomes addicting. And I just was like, I love this. I'm just going to keep doing this thing. So I would just sit there at work and just answer all those questions on the forums. I had all the keywords set up. I would get like pinged and be the first one to reply. And it was fun. It was a lot of fun.
Instant gratification, right?
Yeah, exactly. Yeah.
Well,
good for the ego.
right. It's just another form of social media in a way, but this is one with a purpose where we're building our portfolios and trying to unlock those golden handcuffs for sure.
Yeah.
Well, so I can only imagine, and I've listened to many podcast shows with you. You and I were talking at MFIN, and I was like, "Yeah, you remember the show that you did during like 2 days after COVID started, and like your wife like,
Oh yeah,
flipped you with the back of the back of the hair,
yeah.
your haircut." But anyways, all kidding aside, and guys, we'll maybe like add that link to the show notes. I can't even remember where you were giving that talk.
I'm pretty sure that there's still like screenshots floating around out there. Yeah, my wife, quick sidebar, my wife during COVID, you couldn't go get haircuts, and so my wife cut my hair. And for all the men out there, she said, I'm going to clean up your neck. And when you're a male and you get a haircut, clean up your neck means I'm going to take the guard off and I'm going to like, line it out for you. Well, she took the guard off and she just went right up the back of my skull. I was turned around. I was like, what the heck was that? That was not cleaning up my neck. That was like way different. And, anyway, so I had a webinar that night and I was like, hey, you guys want to see something funny? And I just spun around on my chair and there's this big bald strip on the back of my head. Yeah.
Anyways, so that's how we met. All kidding aside, it's been so amazing to watch your trajectory over the years and just how you kind of bobbed and weaved with the environment and helped so many people along the way. Now, like I said, most of these webinars that I've seen you on have been, really just kind of starting out around like helping investors start, leverage the tax benefits of real estate as they start building their portfolio largely in the single family residential space. Now, you and I were talking back in June, like, wouldn't it be amazing to do a podcast that was solely focused on the tax benefits for a passive investor, right? So let's start there. What are some of the tax benefits that a passive investor, somebody who is investing in somebody else's deals, as a limited partner, actually, reap in real estate?
So the first thing that you have to understand as a passive investor is that you cannot materially participate in the asset. Now, that might not mean much to you if you don't understand Section 469 of the Internal Revenue Code. If you don't understand that, we do a ton of content around it. This is like my little area of expertise, my one little code section that I know inside and out. But it's important to, as an investor in general, not just being an LP, but as an investor, it's important to understand the fundamentals of how Section 469 works. Those are the passive activity loss rules, because in general, you can't claim losses from business activities or real estate unless you materially participate in the asset. And material participation is just like, I'm working on it on an ongoing basis, right? Like I materially participate in my CPA firm. I hold meetings all the time. I'm doing this. This is all material participation. But some of the real estate investments that I make, my property manager runs the entire thing. I don't do anything. So I'm not materially participating in that investment, even though I own it. And that distinction basically changes how I can claim losses. So if I don't materially participate in a business activity or in a real estate activity, the losses coming from the activity are passive losses, and they can only be used to offset passive income. So I cannot use passive losses to offset my W-2 income or my business income, because my W-2 income and my business income are considered non-passive. All right. So Section 469 creates two buckets of income, passive and non-passive. Material participation is non-passive. Without material participation, it's all passive. Now, investing in real estate, I also have another hurdle. I have to qualify as a real estate professional. So real estate is real estate professional status plus material participation. If I don't hit either one of those two things, then my real estate's all passive. So what happens with LPs is I'll put $100,000 into a syndication, and the syndicate's going to do a cost segregation study. They're going to get the bonus depreciation rolling. They're going to pass an $80,000 tax loss back to you, and you get that K1. And your accountant says, hey, you can't claim the $80,000 of losses. These are passive losses, and they get suspended on your tax return because you don't have any other passive income to offset those losses with. That is when LPs typically get pretty mad because they go, wait a second, I invested in real estate for the tax benefits, which is another conversation. You should never invest in something just for the tax benefits. But we hear this all the time. I invested in real estate for the tax benefits, and my accountant says that I don't get any. And so that's like kind of the premise of wanting to talk today, because as an LP, even if you can't claim your losses, you're still gaining tax benefits, and we'll kind of go into the nuances there. But that $80,000 tax loss, it gets suspended on your tax returns. It gets carried forward until you can generate passive income, or until you sell a property at a gain. So if I sell any asset at a gain, then I can use this $80,000 tax loss to offset that gain. We call it a lazy man 1031 exchange. If I have a $100,000 gain in an asset, like another rental property, most people think I got to do a 1031 exchange. But if I also have an $80,000 tax loss sitting on my books, I might not have to do a 1031 exchange. It might not be worth my time, all the hassle to go through the 1031 exchange requirements. So those tax losses do become powerful. They give you options. So it's flexibility that it gives you, but it also protects any future positive cash flow that you might be receiving, or positive passive income that you might be receiving even after depreciation from other rentals. So that loss can offset any passive income. And that's a key aspect of Section 469 that a lot of accountants mess up. They think the $80,000 loss came from Syndicate A. Therefore, the $80,000 loss can only ever offset anything from Syndicate A, which is totally not true. The $80,000 loss can offset any passive income from any passive source, any passive gain from any passive source that you sell. That 80K loss can offset that. So that's like, it's not the end of the world, but we often hear, well, I'm not getting any tax benefits. So to full circle, to answer your question, because I know that was like a 6-minute monologue, so I apologize. But I always like to start there. LPs still get tax benefits, even if you can't claim the tax losses, because think about like a typical rental property. You put you buy it for $100,000. It grosses $12,000 in gross rents. The net operating income is $3,000 after all of your expenses. And let's just assume we purchase it cash just to keep the mortgage out of it. So $3,000 is the actual cash that I receive. But then I get to tell the IRS that I had depreciation of expense of, I don't know, $4,000. So even though the property made $3,000, I'm going to tell the IRS that I had depreciation expense of $4K, which really means that I had a net loss of $1,000. Okay. So I'm going to even though I made $3,000, I'm telling the IRS I lost $1,000 on this property. Did I really lose $1,000? No, I did not. I actually got $3,000 tax. I'll call it deferred tax. I don't want to say tax free, but tax deferred. I didn't pay tax on that 3K today, even though I received the cash. But the $1,000 tax loss that I have, it's passive and I can't use it. So then the question becomes, did you really get no tax benefits? Because you just earned $3,000 of net operating income and you're not paying tax on that today. I would call that a pretty darn good tax benefit, especially at scale. If you can 10 or 20x that, all of a sudden I'm making $200,000 cash flow and I'm not paying tax on it today. That's pretty darn good. I guess in my example, $60,000 of cash flow and I'm not paying tax on it, which is pretty darn good. But that's happening when you invest in syndicates, because the syndicate is hopefully has net operating income, right? Hopefully. And the good ones today have net operating income, but they also have depreciation that's offsetting that net operating income. So even though you see this $80,000 tax loss on your K1 that you can't claim, if the syndicate performed, you still made money that you're not paying tax on. You just have a portion of that rather than the entire thing, right? So that's like the main big idea that we will talk about with our clients that are investing as LPs that come to us and like, what happened to my tax benefits? I thought I was getting some.
So you bring up a really good point here, right? We've been talking about just straight depreciation, and there was a lot of talk at the end of last year of bonus depreciation scaling back from 100% down to 80% this year. I'm sure in September, October, November, we're going to hear a big push of bonus depreciation ticking down from 80% to 60%. How does something like that impact the limited partner investor?
Yeah, I mean, it definitely. So I think before it was 100% bonus depreciation, like you would invest and you would typically get like a $40,000 or $50,000 tax loss passed to you on that K1 for every 100K that you put in. With 100%, we saw like 85% or $85,000 of tax loss passed back in general. Some are higher, some are lower. I just think that as bonus depreciation ticks down, that tax loss that's passed back to you will become less upfront. But even if bonus depreciation was $0, it still makes sense to do a cost segregation study in most cases. The reason for that is we are like, think about carpet. Let's think about $10,000 of carpet. $10,000 of carpet depreciated over 27 and a half years is $363 every single year. All right. So if I don't do a cost segregation study, I get $363 of depreciation from that 10K of carpet. If I do a cost segregation study and I depreciate it over 5 years instead of 27 and a half, now I get $2,000 a year of depreciation expense for 5 years rather than, and then zero after that. And it's not quite $2,000 a year because you use double declining balance, which is, I think, too complex for this. So I know that we have a CPA.
You lost me on that.
Yeah. Well, I got to say it because I saw a CPA in the Q&A and they're probably going, wait, that's not right, which is true. It's not right. But for simplicity, $2,000 a year for 5 years. So from a time value of money perspective, like that makes a lot of sense because now I get a $2,000 deduction for 5 years. So I'm going to strip the tax benefit out of the property quickly rather than have that tax benefit stay in my property for 27 and a half years and just slowly chip away at it. But like with inflation, by the time we get to 27 and a half years, it's $0 real value anyway. So I guess what I'm trying to say is even with bonus depreciation going to zero, a cost seg study is still going to make sense. It's not going to have as high of a return on investment as it used to have. I think that you will probably see an extender bill. At least that's like, we're starting to see some conversations pop up now about extender bills. So I think you'll see one. House Republicans actually released one. I don't know if I don't think that's really going to pass for some time. We'll probably see some activity at the end of this year. But I think you'll see something at some point to preserve bonus depreciation. It's being talked about. I don't know what rate it'll turn out to be though.
Yeah, and correct me any part of my statement here, but how I try to help investors take a look at it is the cost segregation study takes advantage of accelerated depreciation. So now you're changing how you book the depreciation from over, like you said, that 27 and a half years to like how much can you move forward to the first 5 years of the project. Bonus depreciation, as I read it, was more of an incentive, like how much incentive can we give to people to utilize that in year one, right? You don't lose that depreciation you accelerated forward. It's just instead of taking it all in year one, now you get to take it over 5 years, and that's
correct.
Still an impact.
Yes, yeah, 5 years and then 15 years for land improvement. So, these big apartment buildings have parking lots that are all paved. Those are all land improvements, signage, bus stops, that type of thing. So yeah, so all of that type of stuff depreciates faster than 27 and a half years. And cost seg studies, like they've been around for a long time, but bonus depreciation just juices it a little bit, allows you to take it even faster, and 100% bonus depreciation allows you to take it all in the first year. So as it phases out, lower return on getting a cost seg study done, but certainly does not eliminate the need for a cost seg study.
All right, I've got another question that I run into, more of an objection when I'm talking to people about passive real estate. They're like, and this is just real estate in general, not necessarily just passive real estate. They're like, why would I invest in an asset that depreciates, right? You already talked about that. It's not a true loss, right? But if it has to be then reclaimed upon sale
Mhm.
and recaptured, right? So they're already
Yes.
nervous about the capital gains tax. And then, they were like, well, if all this depreciation was taken, then and we sell the asset in 5 years, now we just have to pay depreciation recapture. Can you help us demystify that a little bit?
So yes, there are two types of people in this world. There are very logical people and there are very emotional people. And if you are not a very logical person, then bonus depreciation and that eventual recapture will be very painful for you emotionally, because you're going to forget that you used that tax loss to save money throughout the hold period. Whereas the logical people probably have a spreadsheet where they track it all on an annual basis, and they know they can literally pull it up and see, oh yeah, I got that benefit and I understand it. So depreciation recapture is absolutely something that you have to have a conversation with your accountant about. You have to understand. But when we have these conversations, I've yet to be in, I shouldn't say that. The only times that we are in conversations with clients and we say, let's not get a cost seg study, is when we are going to liquidate the asset within 24 or 36 months. So if it's a hold period that's relatively short, the cost segregation study might not make sense, because you're pulling out these tax benefits today. And in theory, you want to reinvest those tax benefits, right? And so if I reinvest those tax benefits, the tax savings, and what I mean by this is, let's say that I've got $100,000 depreciation deduction. And just to keep it simple, let's say that that creates $100,000 tax loss. Well, if you're in the 37% tax bracket, that's going to give you a $37,000 tax savings. So you will get that back if you've already paid it as a refund, or it'll just reduce what you have to pay on April 15th to the IRS. So this $37,000, that's the tax benefit that I keep referencing when I say pull that tax benefit out of the property. If you reinvest that $37,000 and you let it hang out for 7 years at a 12% rate of growth, you're going to double that money, right? So even if I have to pay it back after 7 years, I'm still left with another $37,000. So that's where the cost seg studies and the recapture, or the fear of recapture, starts to lose credibility. But if I have the 37K and I'm investing in the market, and I only have like a 24-month run rate on that, that might not be enough time to earn the additional value, or to grow that $37,000 to make it worth the time and the effort and the risk to do a cost segregation study, because I do have to pay that 37K back essentially via depreciation recapture. So it's absolutely something that you should understand. It's not something to be fearful of. It's just another piece of the puzzle. And you can build this all out in Excel. Like, it's a very logical problem to solve. So don't be fearful of it, but just be aware of it. Where we typically see people get really mad about depreciation recapture is they totally discount the fact that they were able to claim the losses early on. So they'll get the $80,000 back from the syndication investment via this K1, and the 80K will go to offset $80,000 of income. And then when the syndicate sells the property 5, 6, 7 years later, they go, oh my gosh, I've made basically no money on this because I have this 80K extra gain that I have to pay tax on, and that's BS. It's like, well, wait a second, 5 years ago, you used it to offset income, meaning you got tax savings. What did you do with those tax savings? If you went and bought a Ferrari, yeah, I could see, yeah, you don't have any money to pay back. But if you invested it, you're fine, right? Like you're okay. So that's where we see the pain. It's just not understanding that. But if you are a truly passive investor, and you have like all these losses are just getting suspended and added to your total loss that's being suspended, you really don't have anything to worry about because you're not able to benefit from the tax losses, right? So if you can't benefit from the tax losses because you're not materially participating, you're not a real estate professional, you don't have other passive income streams, then when this syndicate sells at some later point, guess what? That's when you're going to use the tax loss to offset that depreciation recapture. It's going to be a 1-for-1 offset. So it'll effectively be for you as if it never happened in the first place.
Yeah, I love that. I mean, I've heard it referred to like as the golden bucket of losses. And so, getting started and building up those losses, even if you have to suspend it, is still super powerful.
And there's
Now,
strategies too, like to offset, like you can layer your like if I'm investing in passiveinvesting.com and I know that you guys have a syndicate deal that's liquidating in 2023, I can go and place another 100K into another syndicate and get another $70,000 tax loss, right? And that's assuming I've already used the tax loss you guys gave to me a few years back. So I create another tax loss from the new syndicate that offsets or partially offsets the total gain that you guys pass through to me when you sell your syndicate. So you can layer it, and that's what we call a lazy man 1031. I'm not doing a 1031 exchange, but I kind of am at the same time because I'm buying the next asset. It's creating a loss and it's offsetting the gain on this asset that's being sold. So there's ways to limit that exposure. But yeah.
awesome. Well, let's pivot a little bit, because what if somebody is sitting here and going, wow, I have this huge bucket of losses, and it would be such a shame to let that hang out for like 5 to 7 years. How can I tap into the time value of money and use those
Uh-huh.
losses sooner?
Uh-huh. If you already have the losses on your return, it's going to be unless you have control over the assets that you own, those losses are just going to be there for you in the future whenever the time comes. There's really not a lot that you can do. So if I'm an LP investor and I've got $200,000 on my tax returns in terms of suspended losses, I'm an LP investor. I can't call up passiveinvesting.com and say, you guys need to sell this asset so I can use my 200K of losses, right? It doesn't work like that. But if I'm investing as an LP in all these deals, and these deals are giving me a bunch of these tax losses, and if I also own a couple of my own rentals, I can look at my own portfolio and I can say, hey, this rental over here has 150K of gain built in. Maybe the return on equity. Whenever I talk about return on equity, sometimes people give me a bunch of crap about it and I don't, and maybe it's just because I'm an accountant. I understand money, but I'm not a finance guy and I don't hold myself out to be. But like to me, if I buy a property for 100K and it cash flows $1,000 a month, that's a pretty darn good return, right? It's a 12% cash on cash or 12% return on total value. But if the appreciation goes, if it builds in value from 100 to 300 and my cash flow is still 12,000, now all of a sudden it's not that great. That's the way that I look at it, because now it's 12,000 on 300,000. Anyway, whenever I talk about this though, sometimes people are like, no, that doesn't make sense. You're dumb. And I'm okay. Anyway, but that's how I
I
look
look
at
at
it.
it
So
similarly, right? Like, what is
yeah,
your equity doing, right?
yeah. I mean, it makes sense to me, but anyway, some people, yeah. Typically when it's people telling me that I don't know what I'm talking about are like these like CFA types. And I'm like, clearly I'm missing something, but to me, this makes sense. So if I have $12,000 of cash flow on now 300K of, let's just call it equity, maybe I want to sell that property, right? And maybe I want to redeploy the cash, the equity. I want to redeploy into different properties. I could cash out refi if I wanted to, but maybe I don't want to for whatever reason. So I sell the property and I could tap into the 200 or so $1,000 of losses that I have suspended on my books. But that's if I own my own rental. So you have to have control over the assets in order to really play the loss game well. Otherwise, it's just going to stack up on your tax return. And there's like different ways. Like I could buy a property and not cost segregate it. But then I could cost segregate it at some future point, and I could retroactively take all that missed depreciation in that future year. So I could avoid losses until I needed losses. That's a good situation to be in. But if I've already claimed the losses and they're sitting on my return, they're kind of stuck unless I have control over my portfolio. And a lot of LP investors don't.
So let's talk about that. Like, how does somebody achieve the rep status?
So to qualify as a real estate professional, and this is all in section 469. So that one internal revenue code section I gave at the beginning of this, the important one, this is what we're talking about, passive activity losses. So qualifying as a real estate professional allows you to overcome the presumption that your rentals are passive, because what section 469 does is it says all rentals are put into this passive bucket, and those losses cannot be used to offset my W-2 income or my business income, because that's in a separate bucket of income. So to get my rental out of this bucket and over into the bucket of income where my W-2 is and my business is, I have to qualify as a real estate professional, and I have to materially participate in the rental activity. And if I can do that, now my rental activity will be considered non-passive. So it'll be over here in this bucket. And the significance is that if I have a non-passive rental activity and it creates that tax loss of $200,000 or whatever number you want to use, I can now use that 200K tax loss to offset my W-2 income, which is also non-passive, my business income, which is non-passive. So qualifying as a real estate professional and materially participating is very powerful, because any losses created, I can immediately use. They don't get suspended and carried forward. And that's optimal, right? I want to be able to use the losses that I create. So to qualify as a real estate professional, you have to spend 750 hours in a real property trader business, and more time in that real property trader business or businesses than anywhere else. The more time than anywhere else kicks out everybody that has a full-time W-2 job. Every once in a while, I'll run across this, like different groups out there, investor groups that will say, we're all going to qualify as a real estate professional. And they all get FOMO and they all go and like tell their accountants, we want to be a real estate professional. But it just doesn't work like that. You have to spend more time in real estate than your W-2 job. And the reality is that if you work full time, the IRS is never going to buy that you spent more time in real estate than working your W-2 job. And even if you could convince, the IRS is not going to buy it. So you're going to go to tax court, and you're not going to convince the tax court that you spent more time in real estate than your W-2 job. So that's real estate professional status, 750 hours in real estate and more time in real estate than anywhere else. But if you have a full-time W-2 job and your spouse does not, your spouse could qualify as a real estate professional. So that's what a lot of our clients do. You'll have the breadwinner that pulls in the $600,000, $700,000, $800,000 a year, and then their spouses stay at home, and they will manage the rental portfolio. They'll self-manage it. That's kind of a key to real estate professional status. They'll self-manage the rental portfolio. They'll make sure that they're logging their hours, and they'll hit 750 hours. And since it's all they do, they also automatically hit the more time in real estate than anywhere else. And if your spouse qualifies as a real estate professional on a married filing joint return, you effectively have a real estate professional status tax return. So now you can go make those syndicate investments, and you can make all these grouping election, or you can make a grouping election to group your syndicate investments in with your portfolio where you qualified as a real estate professional. And now everything's non-passive. So every 100K that I put into a syndicate, $80,000 tax loss passed back. That's a non-passive loss that can offset my W-2 income.
Wow. Well, and here's the thing. I mean, I talk to investors that, stumble across the real estate professional status, and they're like, I want to get there. And I'm like, but it means you have to be active in real estate. So, where's your time, your highest and best use of your time? And so,
It's a return on your time, right? Like it's always fascinating to me when I'm talking to like a surgeon who is effectively billing $300 an hour, and they want to limit that so that they can save 60K in taxes. It's just like, what? That doesn't make any sense. Double down on the, I mean, I get it, but you really have to think through the hassle and the risk that you are setting yourself up for when you go down this road. And I think what happens is, if you're investing in real estate, you are a little bit more risk tolerant than the average American. Okay. And what happens with risk tolerant people is we all band together into these groups, and we start getting confirmation bias that this is the only way. And we will start taking more risks than we might actually be comfortable taking, simply because we're in this group and we see them all taking the risk, i.e., look at different popular podcasts out there that talk about how easy it is to do all this stuff. And so we just start doing it, right? Without really considering the ramifications. We see this all the time with real estate professional status. Like I said, these investor groups look at together. The lead person is like, I'm a real estate professional, and everybody's going, oh, I'm going to be a real estate professional this year too. But it doesn't work like that. It's not as easy as just changing my LinkedIn header to say I'm a real estate professional. You got to really work on this. And the IRS, they don't audit you with dummies on this stuff. I mean, these are like well-trained tax accountants that are coming after you. So you really got to take this stuff seriously.
Well, Brandon, I want to make sure we leave plenty of time for our Ask Me Anything session, but this has been a wealth of knowledge. Thank you so much for sharing with us today. If people want to get in touch with you and learn more about you, where can they do so?
So if you're interested in exploring our services, you're welcome to check us out at www.therealestatecpa.com. We also have a podcast called Tax Smart Real Estate Investors. So if we have like 120,000 downloads a month. It's a really big podcast. If you are confused at some of the stuff that I mentioned here, especially as it pertains to material participation, Section 469, real estate professional status, we have many episodes. We have entire series within that podcast dedicated to walking you through it step by step. So my partner Tom and I, or co-host Tom and I, we do a really good job just kind of breaking it down into bite-sized nuggets for the layman. So go check that out. And then if you have any questions, you're welcome to email me. My email is brandon.hall@hallcpallc.com. That's hallcpallc.com.
Awesome. And by the way, that is a brilliant URL.
Thank you. Yeah, it definitely helps on the SEO stuff.
Yeah, right.
I just figured nobody knows what Hall CPA is. Who is that? But you know who the real estate CPA is. So yeah.
Well, Brandon, it's been such a pleasure. Thank you so much for spending time with us here today. If you're here live, don't go anywhere.